Welcome to the Level Up REI podcast. I'm Lisa Hilton. I'm an island girl that loves living in big cities. I'm a real estate CFO, real estate investor, and real estate fund manager. Each week, I will bring you episodes on real estate, investing, and life that are inspired by my journey and the people I've met along the way. And if you are an accredited investor, I am currently launching a 506c accredited investor fund. And if you'd like to learn more about my upcoming offerings, you can go to lisahilton.com/invest. Now let's get started. Welcome everyone back to another episode of the Level Up REI podcast. Your host, Lisa Hilton. Today I have on the podcast, Amanda Hahn. And Amanda is both a tax strategist and real estate investor. She helps investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make. She is also the author of the highly rated book, Tax Strategies for the Savvy Real Estate Investor on Amazon, and has been featured in prominent publications from Money Magazine, Talks on Google, CNBC, Smart Money Talk Radio, as well as Bigger Pockets podcast. Amanda, welcome to the show.
Yes, thank you so much for having me. Really excited to be here and chat with you.
Yeah, super excited. This episode is really about taxes as we stand in the middle of 2022. This is typically, I think, one of the times that people should start thinking about their tax situation as they approach the last 6 months of the year, because if they plan to do anything, it's going to take some time to get those wheels moving. So hopefully this episode delivers a lot of really good help and, strategy for people who are in that situation.
Yeah, I love that you said that. I think most of the time people don't think about taxes until January. January through April is when taxes are on people's mind. But you're exactly right. This, in the middle of the year, during the year is actually the best time to be planning, because if you're going to implement any strategies, it's going to be now. It's not going to be, after the year's over. So I love that you said that.
Awesome. So jumping right in, because a lot of people who listen to the show invest passively in real estate syndications, I wanted to start with the tax impact of passive investing. Can you talk a little bit about, income coming from those investments during the whole period, and then when those investments sell at the end, some of the tax implications that they can run into?
Yeah, I am. So in addition to being a real estate investor and just kind of having my own single family and small multifamilies that we have, I myself am also a passive investor as well. So I invest passively in other people's deals. And we also have a lot of clients who either invest passively in other people's deals, or we have clients who are on the syndication side as well. So those people who are sponsoring those deals. And one of the things I love about being a passive investor from the tax perspective is that a lot of the strategies that you hear people talk about with respect to the benefits of owning real estate, right? Specifically writing off deductions against the rental income, being able to take depreciation, right? Where we can write off the purchase price of the building over several years. And, all those strategies on how to, accelerate depreciation and all that, those are all available to passive investors, just like they're available to someone who, had their own single family or small duplex or condo. But when you're investing passively through a syndication, what's really awesome is that you don't have to do the work. So you're not the one who has to hire, a CPA to do all that analysis. You don't have to hire a cost segregation company to accelerate the depreciation. All of that stuff is done at the syndication level for you, right? So the syndicators are the one who's doing all that work, dealing with, maybe some of the headaches of getting that done. And what happens is at the end, in early in the year, hopefully you just get a K1. So you'll get a K1 from that passive investment, and that K1 oftentimes will show, good amount of tax loss. And so effectively what that means for investors is that if you're investing correctly, you're getting good cash flow and appreciation. But on the tax side, you're not having to pay taxes on the income generated currently because of depreciation and other write-offs.
Yeah, very, very important there. And, this jumps nicely into depreciation. Can you start a little bit about the big topic of the year right now, which is bonus depreciation and the fact that I believe it ends at the end of 2022?
Yeah. So depreciation just means that the government allows us to take a write-off for a portion of the building over time. So their understanding is that you have this building, it's got a lot of components within it. And as time goes on, there's going to be erosion, deterioration. So if you have a $100,000 building, we're writing it off slowly over the next, 27 and a half years if it's residential. And one of the strategies surrounding depreciation is that you can have accelerated depreciation. Typically, the way it works is that you have a cost segregation firm to look at an analysis of the building. So instead of saying, here is a $100,000 building that I bought, it's actually made up of a lot of components. So maybe 20,000 in flooring, 30,000 in appliances or specialty plumbing. And once they break out those different components, then your CPA can calculate faster depreciation. So instead of waiting 27 and a half years, you might be able to write something off over 5 years or 7 years or 15 years, right? So traditionally, these are the strategies that investors use when we talk about, maximizing or accelerating our deductions. What's really great about this current year is we have what's also considered bonus depreciation. Bonus depreciation, as an example, just means that if I had, let's say, this property I purchased and I did a cost segregation and they said, okay, well, there's about $30,000 worth of appliances and equipment, right? Furniture or dishwasher, microwave, right? All the other stuff that's coming in with the property. So if there's, let's say, $30,000 worth of those, normally you write those off over 5 years. But with bonus depreciation in 2022, that means you can write off 100% of that immediately this year. So it's sort of, we have depreciation and then we kind of accelerate that with cost segregation. And then the next step is now we also can take bonus as well. So we're kind of supercharging that benefit significantly. There is a little bit of a change coming up that you were referencing. So right now we can do 100% bonus depreciation, which means we write off 100% of that 5-year asset, in my example, immediately. The current tax law is scheduled to start reducing that. So in 2023, if you put an asset in place in 2023, you still get bonus depreciation, but it just starts to trend down to 80%. So instead of having 100% immediate write-off, like we do this year, next year, it's 80% immediate. And then the remaining 20%, you're depreciating it over, whatever the life of the asset is, 5 years or 7 years or 15 years. So we do have a lot of clients, investors who are aggressively looking for real estate or aggressively looking for syndications. The key is place in service. Okay. So for your real estate, you want to make sure it's placed in service in 2022 to get that 100%. If you buy something this year, but you're still rehabbing it, or for some reason or not, it's not placed in service until next year, then it will go under next year's law, even though it was acquired in 2022. So the key things, buy it and also place it into service.
Got it. And then, someone listening is like thinking, how does this really relate to me? Because they might be a W-2 employee and they aren't a real estate professional, which you can get into what a real estate professional is. So they're curious that, hey, does any of this depreciation really impact my investment in any material way?
Yeah, that's an interesting question and one that we hear a lot. And I actually hear that from a lot of CPAs as well, right? It's the most common thing is that I hear is like, hey, you're just a passive investor, so you don't really get any tax savings at all. So people will say, oh, okay, if I'm passive, then I shouldn't do a cost segregation or I can't write off certain things. And that's not true at all. It just depends on how you're looking at the situation. Okay, so if you're a passive investor, meaning, in our scenario, we're assuming that just means you're not a real estate professional and you're someone of higher income, then all that means is that any losses that you generate cannot offset your W-2 and non-real estate income. But it absolutely can offset your other passive income as well as passive income from gains. For example, the sale of a rental property. Okay. And worst case scenario, let's say you don't even have any passive income, we just have tax losses only, then you don't lose on those benefits. It's just carries forward into a future year. So you do get to utilize that to offset future income from passive activities, right? So really what we're talking about here is a timing difference. If you hear some CPAs might tell you, well, you get no benefit when you're a passive investor, that's a very limited way of looking at it. What they're really trying to tell you is you're not going to see a huge benefit today against your W-2 income, but you absolutely will get a benefit at some point in the future, right? Because as investors, what's our goal? Is to get income, right? To generate income, generate gains. And so it's just a matter of timing of when you'll get the benefit. But yeah, we do have clients, let's say you're a physician and you have a lot of W-2 income and, you nor your spouse can be a real estate professional, then sure, you're not going to reduce your taxes immediately. But what if you also have other passive income, right? What if you have, you invested in a surgery center or a dialysis center or something that's kicking off passive income? Well, your rental losses absolutely can offset other passive income or passive income from other businesses that you might have invested in.
Yeah. And what about people who, we have the 1031 exchange. So like they might have a situation where they have invested passively in a deal and the deal is selling and either they don't want to 1031 into the opportunity that's available or the operator isn't doing a 1031 at all. Is that a situation where if they're investing in another syndication in that same year, they could then generate losses to offset some of the gains from the sale?
Absolutely. And a lot of times we rarely see a syndication do a 1031 exchange just because most of the time there's, hundreds of investors in the fund and some people want to exit, some people want to stay. So I think for simplicity, a lot of syndications just choose not to 1031 exchange, in which case then yes, the investor will get a K1 showing taxable income. So first and foremost, if I'm someone who was a passive investor, not real estate professional, right, in that profile we described, well, here's our opportunity. With previous years, I had all these losses from cost segregation and write-offs and things like that my CPA said I didn't get a benefit from. Here's my chance to get that benefit. So if I had a $100,000 gain, but I had $80,000 of losses that have been accumulating, now my taxable gain is only $20,000 because I can use it to offset all of that gain immediately. But yeah, if I didn't have other losses, this deal has just been such a sweetheart deal the whole time, then yes, one of the strategies to reduce that $100,000 gain is to simply take the distributions from the first fund and shop around for additional passive investments to invest in, right? Because ideally, my second investment will kick off some losses to me, and I can use that loss to offset the gain from that first asset that has exited.
Awesome. And then can we touch a little bit about depreciation recapture? What is it and how does that work when an asset sells?
Yeah, so depreciation recapture simply refers to the fact that once you have written off part of the asset, you don't get to claim that again. So what I mean, let's say I buy a $100,000 property and in the same year, if I sold it for $150,000, I just have a $50,000 gain, right? 150 minus 100. Now let's take a more practical example, which is if I have a $100,000 property, I'm taking depreciation. So over the years, if I have already depreciated 20,000, then that means my cost basis is 80,000. So that's what they're talking about. The recapture is the 20,000. I've already written it off. I'm not going to consider that as an expense again. So in that scenario, if I sell my property, let's say for $180,000, then my gain is going to be 100, right? 180 minus my 80 of cost basis. So 100,000 is my capital gains on that. So that's really what it refers to. I have heard sometimes clients will say, oh, my CPA told me not to claim depreciation because I'm not getting a benefit, but I don't want to recapture it. And that's really bad advice because depreciation is actually not a choice. You are required to take depreciation. And so if someone's telling you to choose not to take it, you have to be really aware. Because if you're audited, the IRS does not say, hey, you chose not to do it, therefore there's no recapture. There is still recapture. So just do it correctly, take depreciation because it's, it is a benefit, but even if it doesn't benefit you immediately, it will benefit in the future and it is required. So do that so you don't, put yourself in a bad situation of losing out on a particular benefit.
Awesome. And then can we talk a little bit about state income taxes? So, when some of these syndications, the property maybe is in Atlanta, for instance, and it's sold, there might be a state income tax there might be income taxes at the state level, and that might trickle down to the investor. Can you talk a little bit about that? And I believe that sort of ties in with composite returns, right?
Yeah, absolutely. So, in terms of when you're passively investing in a syndication, or this works the same exact way with a single family home that you own, right, in Georgia, is that most states, with the exception of a handful, most states have state income taxes. And so the way it works is in the first couple of years when you're owning a property, if it's kicking off losses because of the strategies and depreciation and all that, then there's no income tax that you're paying for those particular states. But good practice to file tax returns in that state, whether you do it yourself or composite returns simply just means that the entity is filing the tax on your behalf, right? But in any case, the goal is to file the returns so you can capture those losses in the year when you have losses. Because in a couple years down the road, when the property sells, the expectation is there's going to be gain. And yes, the states will want taxes on part of that gain as well. And so if you had filed taxes in those states before, oftentimes you can carry over those losses, and the losses from the previous years can help to offset the taxes in the year of the gain. Yeah, you're right. Sometimes investors are a little bit surprised that they have to pay state taxes, but unfortunately, it is one of the rules. And again, depends on what state you're operating in. If you're one of the handful of states that actually don't have state taxes, then you don't have to worry too much. The other part too that people sometimes forget is that you might also have to pay state taxes in your home state. So for example, if you live in California, you invested in the property in Georgia, you might have to pay state taxes to Georgia, but also California also wants a piece of that because you're a resident of California, right? So things to be aware of. There are a lot of credits that the states give so that you're not paying, double, triple the tax. But nonetheless, it is something that you want to be on the lookout for. And that's a reason why it's important when you're working with a CPA to file your tax returns. You want to work with someone who's well-versed in multi-state because, if you're like most investors, we're not just investing in our home state, you're investing out of state, especially if you're part of syndication investments. Most of the time, the syndications are going to be outside of your home state.
And I also think that there isn't one specific practice with syndications when it comes to executing composite returns, because you said the composite returns are where the syndication entity files the return in that state and essentially pays the taxes. And they'll do that with taking money out of the distribution that would have gone to the investor to then pay the taxes. And this is typically happening when the investment is sold. If they don't file that composite return, then the investors will then need to file a return in that particular state.
Yes. And even if a composite return is filed, sometimes we found it is beneficial for the investor to file a return because you never know, the investor might be able to get a refund, right? Maybe there's other things going on from the investor's perspective and let me get a refund to get some of that, withholdings back. And yes, so you're right. The practice differs from syndication to syndication. Lisa might decide to do composite. Another syndication might decide they don't want to. And then it also differs across states too. So not all states allow for composite returns. And so you might have something that's in a state where it doesn't have the option of doing composite, in which case then, the only decision is for, to come through a regular K1 and then the investors will decide along with their CPA what they're going to do.
I think the key there is like the investor talking to their CPA and just sort of being on the same page with them in all the different investments and all the different states and working with someone, a CPA that is knowledgeable in all these different states as well. So that way they can help guide them along the way.
Yeah. And one of the things that you and I were chatting about before, just a little bit beforehand was, the fact that there have recently been losses, right? Losses outside of real estate, in the crypto space and in stocks. And so this is a very interesting dynamic because we are seeing a lot of money being made in real estate, whether it's selling your own single family duplex, fourplex, or if you're a passive investor, syndications, exiting deals, right? Apartments being sold, commercial or mobile home parks being sold with lots and lots of gain. And one of the benefits is that generally speaking, if you have stock losses or crypto losses, harvesting those losses can potentially help reduce some of that gain from sale of real estate. So, if you're someone who's sitting on or expecting a significant amount of gain, definitely makes sense to meet with your tax person and try to plan on, what are all the different ways. So we talked about reinvesting in other syndications. Now there's stocks or crypto losses, but planning way ahead, right? Because by next January, it's going to be a little bit too late to look at how can I reduce my gain from the year before.
And so then this moves me right along to, the things that passive investors, they're investing in these deals, they will typically get a K1. When they get that K1, can you talk a little bit about some of the things that they should be looking at when they receive that K1?
I think it's difficult. I never know what the investors are looking for. So first, I would say if you have a CPA who's doing your tax returns, send a copy of that K1 to your CPA sooner rather than later. They'll take a look at it and I think they're the first set of eyes to say, okay, does this make sense? Is it issued to your name, your LLC's name? Which one is correct? Or is it to your retirement account's name, right? There's all these different options. And sending it to them earlier allows them to look at it. Oftentimes that you have the opportunity, if it's, hey, this was supposed to be my LLC name, but it came through my personal name, your CPA will know that and then be able to kind of, help guide you and see if there's ways to fix it. If your tax advisor is not seeing your K1 for, 6 months later, the syndication return might have already been filed and it becomes maybe more costly or impossible to then make that correction. But from the investors, I think for me, I'm always looking at reasonableness. Is this kind of the loss or profit that I'm expecting? I know that is a little bit harder to gauge for investors because you don't really necessarily know what is creating that number. Sometimes we have someone who invested $50,000 and they see a $70,000 loss. And it's like, what happened? Well, those are kind of the tax strategies being done. One area that the investor for sure knows and should be tracking is the distribution. So your K1 will always show your distribution for the year. That's just purely money, right? So match that up to your records. Just double check is, the K1 says I received a distribution of cash of $10,000. Is that what actually came in, right? And if it's not, then, earlier rather than later, send a question to the sponsor and hopefully they'll be able to get to the answer, for you.
One quick question on that, is it best practice? Do you find that some syndications that might have closed, say June or early fall, and then they send their first distribution check, maybe January, they're including that distribution as a part of the 2021 period? Like you bought the asset in 2021 and then you get the K1, but they didn't actually send out that distribution until January of 2022. Do you find that it's incorrect to essentially accelerate the depreciation on the distribution on the K1 by showing it as a part of 2021?
That's an interesting question. I don't see that as a standard practice. So typically, the distribution will match. The K1 will match when the money has been given out. There's always anomalies, right? Differences in what might cause something like that. And I'll give you an example. We had a syndication client who exited a deal in 2021. So they exited a deal in 2021, but the entity still had some wrap up stuff, right? Or even in terms of trying to, pay out small, utilities, vendors and here and there. And they've given out most of the distributions, but there is a little bit left because they don't have an exact number as to what the wind up expenses are. So that might be a situation where if the syndication is deciding, we're pretty much done. We just have some small things here and there, but we want 2021 to be the final year, just so the next year investor doesn't have to wait another year for a K1 that's final with, $10 or $20 here and there. Those are examples where, okay, you might see someone that already are including that on a year before it was actually closed, just to kind of wind it up and make things simpler. So yes, I have seen that, but it's kind of not the norm for just regular operational stuff to report something beforehand.
And then leading into my final question here are retirement accounts to invest in real estate. So passive investors who choose to use their retirement account vehicles, everything from solo 401ks to self-directed IRAs to invest in syndications, are there tax implications for doing so?
Yeah, great question. And retirement account is actually a great source of funding for real estate, right? Because most of the time people have it stuck in the stock market. And if you're one of those people, then you didn't have a good last, couple of weeks. But if you had it in real estate, then maybe you're very, very happy. So yes, retirement accounts are set up in an ideal way to invest passively in real estate. Why? Because as a passive investor, you can't do much. And that is one of the requirements of self-directed investing in retirement account is that you cannot provide sweat equity. So the design of the vehicle and the product really makes sense in my mind. A couple of things to watch out for, okay? With respect to self-directed retirement accounts, if you're investing in an asset that does not have debt, then that's great. There's no issues at all. But in the real world, most real estate deals do have debt. Debt meaning, I have $100,000 I'm investing in a syndication. Syndication takes $100,000 as a down payment and goes out and borrows money to buy this $300,000 apartment building, right? So that's the majority of the time. These are kind of like how the deals are structured. In the initial years of investing in something like this, it's typically okay because we have depreciation and expenses to offset the taxable income. But one of the things is that although the IRS allows you to use a self-directed IRA to invest in leveraged real estate, only the IRA money is growing tax deferred or tax free. So that means to the extent that leverage is helping you to generate money in your retirement account, that is potentially subject to tax. And that is considered unrelated debt financing tax. It is assessed on the retirement account, not on you as an individual, only in the retirement account. And that is at the trust tax rates. So typically, currently it's pretty high at the maximum level. It's about 37%. And it's only on the leverage part. So, as an example, if I had taxable rental income of $100 and this deal is 50% leverage, that means $50 of my income, my taxable income might be subject to this tax. Okay. And again, going back, the first couple of years of investing this type of structure, probably not an issue because typically we're expecting losses. So if you have a K1 loss, 50% of the leverage on the loss is still going to be zero. Nobody cares. But this starts to become a more noticeable issue as you hold the deal longer when we're kind of utilizing a lot of our depreciation. Now we have taxable K1s. Or more frequently upon the sale of real estate. When we sell a property, we have a huge gain. Part of that gain as it relates to leverage might be something that we have to worry about in terms of UDFI taxes. Okay, so this is on self-directed IRAs, Roth IRAs, SEP IRAs, simple IRAs, anything that ends with an IRA effectively. We have to worry about these types of taxes. But the good news is that if you're eligible for a self-directed 401k or a solo K, individual K, you can avoid all these issues regardless of the leverage. So I can invest in an apartment syndication that's 90% leveraged. All of the money grows tax deferred or tax free in the retirement account. Don't have to worry about this UDFI tax at all.
Right. And to be eligible for those, you need to be a business owner and can't have any employees.
So yeah, you don't have to necessarily be, it kind of depends on what you define as business owner. What we tell people is you have to have earned income outside of your just regular job. Okay. So if you're working for Toyota, that's okay. You have to have some sort of earned income where you pay self-employment or payroll taxes on. So you could be a property manager. If you're getting management fee income, you're eligible. If you're a realtor, you make commissions. If you are a CPA and you're doing consulting where you're getting paid as a 1099, right? If you're a salesperson, if you're selling stuff on Amazon and you're getting that type of income, then you're eligible for a solo K. But yes, in terms of employees, for a solo 401k, which is the small business owner's 401k, the only full-time employees would be you and or a spouse. You can have other employees, they just would need to be part-time employees.
Got it. Wow, that was so good. This was so much really helpful information. Before I let you go, can you also talk a little bit on the real estate professional status? What is it? And its connection to short-term rentals, because I know so many people are so hot on the short-term rental space.
Yeah, it's so funny because I feel like the various topics we talked about today, like individually, they could probably be like an 8-hour discussion, right? Self-directed and passive and real estate professional by itself and short-term rental by itself. But yeah, just big picture wise, if we talked earlier about if you're someone who invests in long-term rentals or syndications, right, which own apartments and stuff are usually long-term. And if you're of higher income, typically that's defined as over 150,000 in combined income, then your rental losses can only offset your rental or other passive income. It's not going to offset your W-2 income. The exception to that rule is if you or your spouse is a real estate professional. So if you're a real estate professional, now you can use rental losses to offset your other income, even though, you're of higher income level. So real estate professional, a couple different roles. First is that you have to spend more time in real estate than your job. So if you're working full-time at 2,000 hours, it's going to be very difficult to have more than 2,000 hours in real estate. If you're working part-time, let's say 1,000 hours, you have to spend more than 1,000 hours in real estate to meet that first rule. The second rule is you have to have at least 750 hours in real estate. Okay, so this will apply to more like if you're someone who's working, but your spouse maybe doesn't work, or you are that non-working spouse, then you don't have a job to worry about. You still have to have at least 750 hours. Okay. And then the third rule is you have to meet material participation with respect to the long-term rentals. There's like 7 different ways to do it, but the most common way to do it is to spend at least 500 hours on the long-term rental. So if you can meet all 3 of those requirements, and again, there's variations within each of those, take a while for us to explain. But if you can meet all 3 of those, then that just means rental losses can offset W-2 or other non-rental income. These are all for long-term rental properties. And what I love about real estate professional is that if you are a real estate professional with respect to your own rentals, then and you meet that 500-hour requirement, then the losses from the passive syndication investments can be grouped together with your rentals, and you can use all of that as one bucket to offset W-2 and other types of income. Okay, so super, super powerful, because we have a lot of clients who will say, I want to be a real estate professional, but I don't want to have that be my full-time job, right? I want to have a lot of passive investments too. And so it's a great way for you to be able to use some of those losses from the passive investments to also reduce your overall taxes. Short-term rentals, like you said, super, super popular. We have so many clients investing in short-term rentals. And short-term rental, basically the tax benefit of it is, you get all the things we talked about: depreciation, bonus, cost segregation, all that good stuff. The kind of edge that short-term rentals have over long-term rentals is that you don't have to be a real estate professional to use the losses to offset your W-2 and other income. So in other words, we don't care about how many hours you're spending at your job. To use short-term rental losses, you simply have to meet the material participation, right? Which is one of the 3 that we talked about earlier. So material participation, again, 7 ways to meet it. But the 2 most common ones is the first one is either you spending at least, once you've spent 500 hours on your short-term rentals, then you've met that requirement. You can use short-term rental losses to offset W-2 and other income. The other one is that you spend at least 100 hours, but no one else spends more time than you. So you can meet that as an alternative. Then you can use rental losses from the short terms to offset your W-2 and other income as well. Very, very powerful strategy for a lot of our clients who, maybe has a full-time job, or both spouses have full-time job, but really want to reduce taxes. I was just working with someone that 2 working spouses just work on their tax return before our, our show today. They're getting about just under $300,000 of losses to wipe out their W-2 income. So very, very significant. So probably they're looking at over close to $130,000 in refunds, in actual cash refunds.
Got it. Very powerful. And that 500 that you mentioned earlier, you just need to qualify for it one time. You don't need to do 500 each year.
So it is a year-by-year distinction. So meaning if I'm buying my rental property this year, if I meet those requirements, the losses I generate this year can offset my income this year. Next year, it's a whole new year. So the question is, do I have losses? Do I have the hours? What's my other income? So yeah, every year is on its own. And, like during COVID, we had a lot of people who qualify because people stopped working by choice or not by choice, and then focused their time into real estate. But, after COVID, maybe they decided I want to go back to work, or, so yeah, it's a year by year distinction that you can, you don't have to meet it every single year.
Wow, this was so good, so helpful. Thank you so much, Amanda. Like, if my listeners want to learn more about you, to get your services, for tax work, et cetera, where's the best place they can go to learn more?
The best place, I think, for people to find me is on the website, www.keystonecpa.com. If you, like I said, we didn't really have enough time to go over all these strategies, but I do have an ebook, a free ebook that you can download. It's called Tax Strategies for Real Estate. And in there, we talk a lot more in depth about real estate professional status. We talk about, ways to maximize your deductions. Like how do you shift income by paying your kids and take a tax write-off? Or what type of legal entity is best for my real estate, right? So we talk about a lot of those things, and you can download that at keystonecpa.com. And we always try to provide tax updates, webinars as well. And you can check those out and participate in one of those there as well.
Awesome. So good. Thank you so much. I really, really appreciate it.
Yeah. Thank you so much, Lisa. That was fun.
All right. Thank you so much for listening to this conversation. If you enjoyed it and want to dive into another episode, then check out the links in the podcast notes or go to lisahilton.com/podcast. If you are listening on iTunes or Spotify, please follow, rate, and review. And last but not least, if you are an accredited investor and you're interested in checking out my upcoming 506c real estate fund, then please go to lisahilton.com/invest and sign up to get in the club to learn more. All right, guys, until next time, keep leveling up. Bye.